Hello, everyone, and welcome to the show. My name is Chris Alaimo.
And I'm Ben Gassaway. Together, we are the Amateur Investors.
This podcast is our open source journal of everything we learn about investing and wealth management.
We're here to explore the key concepts, market dynamics, and investing strategies that will assist you on the path toward financial independence and financial literacy. Our mission is to build us up from amateurs to experts.
All suggestions are our own, and we recommend that you do your own research before taking any investment advice. See you in this week's episode. We hope you enjoy it. Hey, everyone. How's it going? This is the Amateur Investors Podcast. My name is Chris Alaimo, here with my co-host, Ben Gassaway. Ben, how's your week been?
Chris, it's been a pretty good week. Still in lockdown, as I think most of the U.S. tends to be right now. But thankful to have, a little bit of sunlight. It's Saturday in New Jersey, and I feel like we're warding off a pending winter. But Chris, really excited about this episode today. I feel like this is sort of fundamental to what it means to be an amateur investor, is to, understand what is a stock.
Yeah, I agree. Stock market's been a little wacky lately. The S&P 500 hit its
Definitely.
all-time high, I think, like Thursday or Friday or something like that.
Yeah.
That kind of makes me think things are overpriced or we're, something else is coming around the corner. They've been a little volatile, definitely this week and last, but overall, good portfolio, the way my portfolio looks. So we'll get into the basics of what are stocks and bonds. So for our listeners and or viewers, if you're watching this on YouTube, basically like a stock is just, in layman's terms, it's a small share of a company. Granted, it's normally a small percentage if it is a large, Fortune 500 company or one of the more well-known companies, a very, very, very small percentage if you're buying just one share. But overall, when you're buying a stock, you're buying a piece of that company. Ben, I guess you want to expand on that?
I think that's the key differentiator from a common thought about what it means to buy a stock. I think there's like sort of two schools of thought, that there's this abstraction of there are just these stocks that float around in the ether that is the stock market, and you are just buying a number that moves around and you hope it goes up. Sometimes it goes down, but it's sort of what people would call gambling. And I want to sort of disprove that common misconception a little bit later in this episode. But
yeah,
what it means to buy a stock, really, I think you should be thinking about, I am now the owner of a company. Shares are issued in the form of an IPO, an initial public offering. And what that means is that, when a company is private, this is basically just a giant fundraiser for these companies to issue shares or equally divisible pieces of that company. And when you buy at that IPO, that gives the company cash to grow, and you have basically just issued a loan at zero interest with no promise of repayment. The goal is that the stock, you hope it will go up, or that the company will issue dividends. But that's pretty much what the initial public offering is. And once a company is listed on a stock exchange, the company doesn't receive value for that. It's really just the perceived value of that company changes. So when you buy stock, you're the owner.
Yep. Yeah, and we can kind of touch on that too. So basically, there's normally two ways that a person or investor in a stock makes money, or a company. So typically, the investor would buy shares or a share of the company, and with hopes or knowledge or anticipation that the market goes up. Obviously, that's not always the case. Sometimes companies go bankrupt, things happen, stock goes down. But overall, when you buy a stock in a company, you're hoping that it goes up, and then you sell that share. So if you buy it at $100 and it goes up to $120, you sell it and you make the profit, or the $20 on the difference. Obviously, there's different things called capital gains. So if you hold a stock for less than a year, you pay 35% on the capital gain. So if it goes from 100 to 120, you pay 35% of that $20, and you would only make quick math right here. Let me do that. Pull up the calculator.
There's no shame in using a calculator, Chris. I still use a calculator for 2 + 2 just to be safe.
Yeah. So on the $20, 35% capital gain. So if you buy it today and then a week from now it goes up to 120 and you sell it, you pay $7 in taxes essentially, and the other 13 you would pocket. So you bought
Yeah,
100. Go ahead.
and something interesting about capital gains, it's income dependent. So I think, Chris, maybe one day we do an episode on this, or even just at least share, a resource to calculate capital gains tax, because it varies by your income bracket.
Yeah.
So at the end of the day, it's essentially an income tax depending
Yeah.
on when you sell.
Yeah, and then if you hold it for less than a year, it's normally. So I guess these are just generalizations. It's either 35% if it's less than a year, and then it's over 15% if it's over a year. Basically, this was kind of done to prevent people from constantly buying and trading stocks like day traders. It's more incentivizing them to hold it for more long term. And the SEC, I think, was the one that passed this rule probably in like the 70s or 80s. What they're ultimately trying to do is reduce the volatility of the stock market. They don't want everyone almost like treating it like, when the banking crisis, when everyone was trying to withdraw all their money from the bank at once when times get tough. So it's their way of incentivizing people to stay into the market longer by taxing them at higher amounts if they're trying to constantly move in and out of the market. So if you're holding for over a year, that'd be $3 that you'd pay on your $20. So you're making that $4 margin, which doesn't seem like a lot, but if you think about it, it is a lot in the grand scheme of things.
Yeah, I think that goes into, going back to what I was saying, that a lot of people tend to default to the statement that, investing is essentially just gambling. And my, I guess, rebuttal to that statement is, yes, it is, if you don't do any research, right? Like the analogy that I like to give to people when I'm trying to explain like what it means to own a business and how you can make money on stocks is, at the end of the day, these are real businesses that exist, that are generating money. And when you buy a share or a stock, you're getting a piece of the pie of that company's profits. And the analogy that I like to use is, if you could buy a money printing machine, would you buy it? Chris, would you buy a money printing machine if you could, legally, if you could buy a money printing machine?
Well, that depends, Ben. How quickly does it print money, or how quickly does it make money? And how quickly can I see those returns,
At the end of the day, Chris, that's exactly the right question. If you have a money printer that can print $100, that sounds great, but how long does it take to print $100? If it takes a year, would you be willing to spend $1,000 to buy that printer? Maybe. It takes 10 years to get it back. If you had to pay $10,000 for that $100 printer, probably not.
Yeah.
And that's kind of the decision point that you get to is, how much am I paying for this company? That's the share price. And how much profit is that company making? That's the money that is accessible to the investor, to the shareholder, that profit. That's what you care about. And if you just do those two things, understand the share price, what is the business worth? How much money are they making? You're on the right track to understanding, is this a business to invest in? Not necessarily is it a great business. It might be a great business, but it might be too expensive. That money printer might just be too expensive today. And the nice thing about the stock market is, the one thing I can promise you is it moves every day. Whether it goes up or down, it will move, and I promise that.
Yeah, here's kind of like the layman's analogy that I heard not too long ago that I actually love. They did it in terms of players, in terms of sports, kind of the world that I love to watch, and many people do. And they were talking about LeBron James. So if you are the general manager, or you were the general manager of a franchise, and you had the ability to sign LeBron James, if you could sign LeBron James for $3 million, is that a pretty good deal? Yeah, I would say so.
I think
that's
so.
a very, very good deal.
I'm not even a
especially
sports guy.
since his current contract is like $330 million, I think is what it is. I think it's $330 million that he signed with the Lakers over, I forget if it's 5 or 6 years. So if you had the ability to sign LeBron James for $330 million, is that a good deal? I would say so, because the Lakers just won a championship. So they definitely are getting their money's worth off him. Now let's just say you could buy LeBron James or sign him to your team, but it's $3 billion, $3 billion with a B. Well, you're paying $3 billion for one player. Now, not getting into whether LeBron James is worth $3 billion, I could argue that he is that worth that much with a lot of his endorsements and deals and TV ads and stuff like that. But as a team, as a franchise, if you're capped at the amount of money that you have to spend on other players, which the NBA is, they have a cap, then they would not be able to sign any other players. So it's not a good deal. So that's just a simplified way of making it very easy. It's there's great deals, there's okay deals, and then there's bad deals. If you look at it in very simple terms like that, that's basically what you're doing when you're investing in a business. Now, the way that you would do that in investing in stocks is you look at how much money you have, you look at their financial statements, which we can spend a whole nother episode on. That's the balance sheet,
100%.
the income statement, and the cash flow statement. And those are kind of the three things that you're looking at on top of what the price is for what it's selling for, to figuring out if it's a good investment or not.
Yeah, and I think that Chris, that was a great analogy. And at the end of the day, like stocks and the market tend to be this lofty abstraction where it just feels inaccessible because some of these terms might not have been defined to a person, or like you might not have heard some of the like market cap, shares outstanding. Like there's some terms that might inundate you from understanding what it means to own a stock. And like you might see a stock share price. I think we should also have an episode about just like common misconceptions and common mistakes about investing that I personally made. But when you see Amazon share price of, as of today, it's like 31.25 exactly.
Mm-hmm.
That sounds expensive because it's a big number, and it is. Like it might be expensive if you're going to go buy, one of the PS5. It's probably overpriced if it's a PS5. But what does that share price mean? What you need to do is understand how many shares exist in the system,
mm-hmm.
that are held by, institutions, Goldman Sachs, Ben and Chris. And that gives you an idea. When you multiply that share price by those shares outstanding, that's what people are talking about market capitalization or market cap. Or when, someone says that Apple just passed $1 trillion, I think they might be $2 trillion right now. But Amazon is about $1.5 trillion, and that's the value. It's the share price times the number of shares. Yep. And that's it. So when you buy a share of a business, when they say that maybe the company made $100 billion worth of profit last quarter, divide that by the number of shares outstanding. You just type in shares outstanding of Amazon, and then you'll understand how much profit did they generate per share. And what does that mean? Your mini business, your one share, that's really what a share is. It's basically just a mini business that you can hold in your palm. You just need to, it's just scaled big numbers. That's all it is. It's just small money printing machines in your hand.
And it's kind of, I know you were talking about this before the episode talks. It was almost in Shark Tank, when they're like, oh, I'll pay you $100,000 for 5% equity of their business. It's exactly like that on just a much smaller scale when you're buying one share of these large corporations. Obviously in Shark Tank, that they're more startups, or, they're smaller businesses looking for money, where, Amazon is the behemoth that it is today. Apple is the behemoth that it is today.
So that's entirely an apt description, Chris, of what it means to go from the private equity, when you're not listed on a stock exchange. That Shark Tank analogy, I think it is exactly apt to pre-IPO, because what are you doing when you buy pre-IPO shares? You are literally just giving that company a loan. You're giving them cash to grow their business in exchange for ownership, a piece of the ownership. And that's exactly what an IPO is. That's exactly what Shark Tank is. But when you're buying a stock on the stock exchange, all that's doing is it's just a perceived value. It's a commodity at that point. Shares might be given to executives and companies for incentivization. If you're doing a good job as a CEO, the market should see that company's value as higher. And that's why, you'll hear that like CEOs are holding shares, executives need to disclose where they hold shares. It's an incentive structure to make the perceived value of a company move. But by the share price moving, that doesn't mean that, Apple or Amazon is making money off of those shares. They're not, unless they are buying back their own shares, which is another topic. But I think that's a common misconception, is like that when you buy stocks, it's going to Apple. No, when you buy a stock, it might have been that Chris literally sold me his share. There has to be a buyer. There has to be a seller. It's
Yep.
not you to Apple. It's me to Goldman Sachs. It's me to a person or an algorithm these days.
Yeah.
So that's just something I wanted to clarify.
Yeah, so kind of going down that path. So we were talking about how stocks, how you can make money by buying it, holding it for a certain amount of time, whether that's 6 months, a year, 30 years, 40 years, whatever it is when you want to finally recoup the money out of it. But there's another way that you can make money from them. It's called dividends. Dividend is basically when a company pays out a portion of their earnings to their shareholders. Typically, a good number to run with. I mean, this varies across all stocks, but normally the average, the overall average for dividends is around 3% or around that ballpark, 2.5, 3%. Let's just use 3% as
Now,
a
Chris,
number.
that 3%, is that of their earnings?
That is, yes, that is of, or not of their earnings. It's normally of the price of the stock.
Got it. Got it.
So normally it's not, you're not getting 3% of what they earn. It's normally the price is whatever it is. And then it's normally about 3% of whatever
With
that
some
stock price
thresholds.
is.
Got it.
Yep. And obviously that can vary. If the price spikes up, all of a sudden that 3% that you were getting, if one day Apple's at $10 and they're paying 3% of that, which is what, 30 cents. Yeah. If it's $10 and it's 30 cents they're paying you, and then it jumps up to 100. Dividends normally don't, it's not all of a sudden now they're going to pay you 3%. It's
Yeah.
normally over time the company keeps adjusting their dividend, and they can go up or they can go down. In the times of when the market's not doing well, or if a company's not doing well, they'll cut their dividend. So, like anything, there's risk with anything. If a company's not doing well and they're paying $1 dividend, they could cut it down to 30 cents or 25 cents, or
Yep.
say this quarter we're not giving a dividend. A lot of times that affects the market price. So if this company's steadily been going up in their dividend and all of a sudden they get rid of it, that means you see an effect of people dropping the stock, because normally they pay out dividends quarterly, and a lot of people use dividends as a source of income. Obviously, the extremely wealthy or a lot of retired folks, or even people around our age, use it as a form of small income that they can use to buy other assets. So that's just kind of the basics of it. And getting not too much into the details again, but there's also different types of stocks. So typically the two that you hear about are common stock, which you can kind of buy on Webull or Robinhood or through Fidelity or a stock exchange, or it's normally what's held in your portfolio in a 401k or a 403b if you're a teacher or in the United States government.
Right.
Yeah, any type of government job, basically. Preferred stocks are kind of act like bonds, and that's kind of what we're going into next. They kind of have the upsides and the downsides of both bonds and stocks. So normally they get paid dividends first. So if a company's cutting dividends, sometimes they cut it from only common stockholders and not preferred stockholders. And then they also get paid first. So normally when they pay dividends, they pay them out in a couple days. So a preferred stock might get it a few days before a common stockholder. And I know that's a lot of information thrown at you. So I don't know if you want to elaborate on that, Ben, now that I've been talking for a little bit.
No, I think that was a good explanation. To be quite honest, I don't know much about preferred stock. I just have never been in the position to be able to be graced with preferred stock, but I'll definitely do some research for our listeners here, because I know there's just been some pretty good stories, especially from Warren Buffett, going into the market with just a boatload of cash and getting preferred stock deals. I know Goldman Sachs was a big deal that he made quite a killing on. So I'd love to give like a market example. Maybe I'll type something up in our show notes at the bottom as a resource.
Yeah. I mean, they're basically frequently compared to bonds, and it typically pays a fixed dividend. So I don't know how often it's changing, if ever. Like I said, I don't have the ability to be lucky as well with that as well. Also,
From what I know, it's a contract. It's basically a contract.
Yeah, and
More
they get
than just
preferential treatment when the dividends are paid out, like I said, but before the common stock holders, but after bonds. They're typically more secure and they don't move as much, so you get less of the upside, but you also get less of the downside. And typically, if a business goes bankrupt, they pay out in order of bonds, preferential stock, and common stock. I will just say, from looking at historically, Normally, when a company goes bankrupt, common stockholders don't get paid at all.
It goes to zero.
Typically, they pay off debt they pay taxes first, then they pay off debt, and then they pay bonds, sometimes preferred stock, but rarely. And then common stock, it's normally like you're out of luck. It's your money is gone. The investment is no longer there. So kind of moving into bonds. I don't know, Ben, if you want to start us off, and then I can kind of pick up anywhere that you don't touch on, basically with bonds.
Sure. So, as defined in the dictionary, and I'll just read it off, but I'll give sort of my summary of what it is. It's an interest-bearing certificate of public or private indebtedness. At the end of the day, a bond is an IOU you are essentially the loan seller as the investor, and a borrower is typically an organization. It could be a government. That's where you hear, the term treasury. It could be a company, which in the form of a corporate bond, agency bonds. You might have heard of Fannie Mae or Sallie Mae. And there's also municipal bonds. So bonds, you are giving that organization a loan, and in return, they are paying an interest payment, and that's really what the coupon rate is. So you are issuing a loan, and instead of, with my student loans, where I'm just paying just a happy amount of money and lots of interest, you're on the other side of it receiving those interest payments. It's typically a very secure means of a fixed income financial vehicle, essentially.
Yeah. So also, I forget if you want to look this up, Ben, while we're talking,
Sure.
But I know the bond market is much bigger than the stock market by a market capitalization standpoint. I know, I want to say the bond market's 3 times the size of the stock market, 2.5 times. But basically, I know Ben was talking about, it's exactly what he was saying. It's a loan. So whether that's the government, a business, or a municipality, they need money. So you give them money, and then over time, they pay you a steady interest rate. And then at the end of the loan, they pay you back your full amount. So when he was talking about coupon rate, it refers to the type of fixed income. So for example, let's just say you buy a bond for $10,000 with a 10-year maturity rate, or basically that's the time that they're going to pay you back over, and at a 5% rate, a coupon rate. So they would pay you $500 a year, and they can break up those payments however they want, whether it's once a year, twice a year, every month. So they're going to pay you $500 a year for a decade. At the end of that decade, you're going to go back with your final coupon. So your final coupon statement, let's just say once a year. So $500 once a year. You're going to go back and give it your final coupon, and then the issuance of the bond. So your final payment, so $500, $500, $500, $500 for 10 years. And then the last year you're going to get $500 and the $10,000 you once invested. So overall, over the course of 10 years, you would have gotten $15,000 from the payments of the $500 for the 5% coupon rate and the total amount of the bond that you gave. So that's just kind of it in simple terms, using a simple example. Obviously, like any investment, any investment is not risk-free. Typically, bonds are given gradings by different companies. Fidelity is normally one of them, or even I think Experian gives them. There's multiple companies that give grades. Typically, the way
Moody's,
that they break,
I think Moody's is another one.
Yeah.
Sure.
And so the way that they rank them is in a scale. It's normally goes from AAA all the way down to, I think, is it D or lower D? I forget the rating scale, but a AAA is very good and secure, or what they're saying is secure. Typically, that's the U.S. treasuries or the federal government. When you're buying a U.S. federal treasuries bond, that's much more secure. Then kind of coming down the list, there's corporate bonds. There's good corporate bonds and bad corporate bonds. Based on the ratings that they give, it's more secure. I'd feel much safer giving it to an Amazon or an Apple. They would probably have much higher grade corporate bonds than Joe Schmo's mechanic shop or whatever it is, or Joe Schmo's, mechanic national shop or whatever it may be. Then there's things called high yield bonds, which can be in other countries or other places. Typically, in order to make the investment worth it, they'll give you higher interest rates or a bit more money per coupon, like per coupon that you pay, but they're much higher at defaulting or losing all your money there.
Correct.
So with the higher interest or money payments, you have a much higher, if they default, you might not get your money back at all. And then the last one are municipal bonds, which are state or local or municipalities, and they're also called munis. Like I said, kind of going through it, the U.S. is one of the safer ones. Normally, there's a small chance that the U.S. will default on a lot of the bonds that they have, which is a very good thing. It makes it very secure, but also with that security means that they don't pay that high of an interest rate. And now, Ben, I don't know if you want to elaborate kind of on interest rates and how they affect the bond market and bonds in general.
Yeah, I think just before I dig into that too deeply, I think bonds, just like the terminology might feel a little bit complex with just like, the terms are sort of innate to bonds, bills, notes, what have you. But at the end of the day, when you go to take out a loan to buy a car, to buy a house, you can make a Credit Karma account. We're not sponsored by Credit Karma. You make a Credit Karma account and you check your credit score. When you go to get your car loan, that interest rate is really tied to your credit score. It's the likelihood based on some metric of you paying back that money. And that's basically, that's exactly what Chris just went through in terms of like the thresholds of types of bonds. It goes in order of likelihood of repayment to least likelihood of repayment. And the interest rates is that an inverse correlation where if one is more risky, you get, I guess it's direct.
Yeah.
So when the risk goes up, interest rate goes up, but that means you might not get repaid. So interest rates, when people are talking about that the Fed is changing interest rates, I think people are thinking like, oh, my savings account is going to change, or my student loan account is going to change. Not necessarily. Inevitably, it probably will, but those changes are not linked to the Fed pressing the button to say, interest rates are changing. When interest rates change, what that means, or when the Fed is adjusting interest rates, that means that the rate with which banks can lend money to banks has now changed. And that dynamic is really, really important because at the end of the day, when you go to get a loan, the bank is the person who is going to be receiving the interest rates. So it's sort of like, this is not a very good description, but it's sort of like a trickle down system where the top folks, it kind of is. The banks in their interest rates and how they lend. So like right now, where it basically is, they're holding interest rates at zero. So the banks make $0, zero interest on that money in the banks. So the rates that they can charge to customers will not be zero because they still have some liability for holding your cash. So, issuing those loans, they'll still receive interest, but largely the interest rates will be lower as a result of that bank lending rate changing. So that's what it means when they say Fed is adjusting rates. It's the rate with which banks can lend to one another.
Yeah.
I don't know if that was valuable.
No, that was good. And I know that we're kind of wrapping up here now. I know that there was a lot to throw at you with stocks and bonds and coupon rates and maturity rates and all that. Definitely, you can always drop a line to us on any of our social media accounts or even shoot us an email if that's easier to do at the amateur investors with an S at the end at gmail.com. We'd love to help you guys out and learn anything about it. So, new segment of the week of the podcast. So I'm going to ask Ben these quick 3 questions. I actually
I'm nervous.
or statements. And I refused to even let him know before the episode because I just kind of wanted to get, ask him the question, see what he gives me. All right. So, Ben, here's a statement. I want to see how you feel about this one.
Okay.
So what are your thoughts on the statement? Broke is a temporary financial condition. Poor is a mindset. Agree, disagree, comment. What are your thoughts on that? So I'll say it again. Broke is a temporary financial condition. Poor is a mindset.
Poor is a mindset. Okay. So I guess we're doing a little bit of semantics, gymnastics. I guess is the question, do I agree with that? Or like, what are my thoughts?
Yeah. Do you agree with that? Do you hate it? Do you love it? What are your thoughts on it?
I like it. I do like the statement. I think before I'll try and like stream of consciousness work into an answer. I think I agree with the statement, but there are disclaimers. Being broke or, being broke, talking about the financial space, not necessarily the mentality space of the poor being the mindset. Being broke, being temporary, I would say definitely does not imply that it is easy to change that.
Yeah. Okay.
There are many mechanisms that make it really quite difficult to accumulate wealth quickly,
Yeah.
right? It takes a great deal of effort to change, I think, income status or like social status or like socioeconomic status. I think it is really quite difficult, just given minimum wage across the country. Like there just are varying. There are variables that make it difficult to change your financial status, but there are, especially in the age of the internet, I think that there is absolutely means with which that you can change your status. I think that we're not really quite there with fully accessible education, high level education, especially in university. But financial aid is definitely something that has, I think, flipped the script for folks to be able to go to colleges and hopefully not be burdened with too many loans. So if you have the means with which to, study and do really well in high school and middle school, and then get into college and then continue to work hard to build your financial status, I think that there are means with which to do that. You can start an internet business, e-commerce. I think if you are creative and you're willing to pursue a change, you can do it, because I don't believe in, your income level or what you're born into is what you'll be. I mean, there's so many cases where that's not true. And so I firmly believe that absolutely it's temporary if you are willing to put in the work to change it. But there's also there's also a matter of luck to that. And I think that's the mentality of being poor. If you decide that you're poor mentally, you're going to stay broke. But if you decide that I'm going to change this, I will be rich, well, you might find value along the way, and it might not be that you're a billionaire or a millionaire, but the fact that you're on the journey to better yourself and improve your status, I think I do agree with that. I think that it is temporary only if the mentality fits. So if you can change the mentality, you can change the physical state.
I agree. I think there's ample opportunities out there. That quote's from Robert Kiyosaki, by the way, Rich Dad, Poor Dad. Also not sponsored by him.
I need to read that book. You gave it to me.
I did send you that book. So, all right. So next question. I got two more. So what would be the outcome? This is a hypothetical. What would be the outcome of a person that saves and does not invest in anything? What do you think their long-term success would be, or what do you think of that statement? So what would be the outcome of a person that saves and does not invest in anything?
It's certainly a loaded question, right? Yeah. Like I think it depends. One, how much are you saving? I don't know what that means. If you save $1 a year, well, then if you're 70, then you have $70. So saving money is fine. But I will say that the reason why investing is so attractive, regardless of your income level, if you have liquid cash that you're kind of sitting on, that you're able to have an emergency fund and you can live within your means, investing your money means that your money gets to work for you. We'll talk about compound interest probably in another episode, but if you only save, that money will only grow as fast as you can save it. Whereas with investing, when you save your money, you are saving money that is now making money on your money because of compound interest.
Yep.
And whether you're being paid with dividends or the stock is just appreciating and going up, you can honestly become a fairly wealthy or well-off person just by sticking to a consistent investing strategy, because when your money multiplies on the money that you have, that is just an exponential differentiator from the savings rate, which is just linear. So can you be successful, be happy by just saving? Yes. But it may require you to work longer than you would like. You may still be reliant on your job. You might be reliant on some government support programs, but not necessarily. It depends on your income level and how much you've managed to save. But investing gives you that ability to make money. Even after you stop working, your money will always make money for you. So the outcome is, I think, you will just have likely less money than if you had invested. I guess that's sort of the in a vacuum, that's what the situation is that you just will probably have less money than if you invested it. properly.
And then the last statement, this is, more of a morality question. So is
Okay.
money inherently evil or bad? What are your
Oh my
thoughts
gosh.
on that statement? Is money inherently evil or bad?
Inherently, no. I'm going to say that off the cuff. I'm going to say no.
Yeah, I agree with that. I think, the more money you have, having money, and this is a great quote that I've heard as well. Like when you have a lot of money, it's not, it basically, it inflates who you actually are. So meaning if you're a good person and you get a lot of money, the truth kind of comes out. If you're inherently bad or you're not a good person, having more money just compounds and makes it worse. If you're truly a good person, having more money can, elevate you and make you an even better person or strive to be a better person. That's just my personal philosophy. And I think, having a lot of money, it kind of spreads light or the truth of who you actually are as a person. So
Yeah, I think I totally agree with that. When I say like money is not inherently bad, I think like money in a vacuum, again, going into that vacuum, it's just an arbitrary value to go do something or get something. It really is sort of um, broadly power in measurable terms, I guess. I don't know if that's correct. But I think having, like you said, having a lot of money, the person at the end of the day or the actions are what defines the morality. I think the money is sort of a system.
a tool or a vector that you
It's
can
it's a
use.
utility at the end of the day to
Yeah.
decide whether someone can go get this thing and to hopefully prevent too many people from owning too much of the things, which is like the moral case against like billionaires, where it's like they have all of this money. And like you said, it shows to like, what are you doing with it? Like, I want to think that if I were a billionaire, that I would distribute almost all of it. I think I would probably live lavishly because I'm a person. But at the end of the day, I would want to do everything that I could to add value to the world. Because
Yeah.
if you just have all that money, you're not helping a country in terms of their GDP. You're not paying taxes to Amazon. And I think, yeah, I think money is not inherently bad, but people are fickle creatures, and having power makes us do different things, and desperation makes people do scary things at times. And I think it's a difficult system to manage, and that's why you see this wealth disparity. That it's something that everyone wants, but not everyone has.
Yeah.
So money, in theory, very good. In
It can be
practice,
used for bad. All
can
right.
be used for bad.
Thanks,
Chris.
guys. Those are all the questions I got for Grilling Ben on the spot. Thank you for listening to our episode. Make sure to check out our social media channels. We're on Twitter, Instagram, Facebook. We have a group, YouTube. We appreciate so much for you guys listening or watching. Have a good week, guys, and we'll catch you next week.
Thanks so much.
Have a good one, guys. Bye.